Oh, the arrow disappeared.
Greetings, everyone. My name is Peter Young, and I'm president of Societe de Chimie Industriale, the host of this event, and I'm also head of programs. And I'm very pleased to welcome you to this session. Kevin Swift, I've known for many, many years, and he has been a very popular speaker at our events at least once a year. He's very well known, so it's really there's not much I have to do in terms of introducing him. He has a long career, a very successful career in economics, and is probably the leading expert on the economic perspective for the chemical industry. And many of us really have depended very heavily on Kevin's data on where the growth and where things are headed, but also on his predictions of where things are going. Now, the only one thing that's different this time when I introduce him is I usually introduce him as the chief economist of the American Chemistry Council, but as of 7 days ago, I guess, Kevin,
yes,
he has stepped down as the chief economist. It was his own decision, and he'll comment, but it really related not to his love of the HCC, but more the kinds of issues that people have around where they should be physically located. But he is very, very respected, and I think this session on economic energy and the chemical industry trends and outlook, I think will be very, very helpful to all of us. But before we start, I just want to say that Societe de Chimie Industriale is well known to many of you. Those who don't, it is a 102-year-old nonprofit that was founded for the purpose of serving the chemical and life science industries. And we have at least 3 missions. One is to educate our members and non-members on important issues that they have to deal with in being in the industry. And this program is part of that. Then we have a huge program helping to support students who are studying chemical engineering, or biotech. We have research scholarships, we have mentor programs, and we started in the beginning of this year a career fair and forum to help match students at the leading schools with companies who are hiring talented people. And then, of course, we give the International Palladium Medal Award to someone who has really shown in an exceptional way their dedication to the goals and aims of Societe de Chimie Industriale. With regard to upcoming events, there are a couple that I want to mention. At the end of September, and these dates are on our website, we will have a panel on what's the impact of ESG, which is environmental, social, and governance, which is a very hot and important topic these days on the chemical industry. And then it'll feature Rob Westerfall, the editor-in-chief of Chemical Week, Joe Chang, who is the global editor of ICIS Chemical Business, and then myself. And we'll talk about this very important topic and what effect it's going to have on the chemical industry. We then, in November, we have Steve Sommers, who is the president of Vigon, a very successful company that's small but grow very, very rapidly under his leadership in the flavors and fragrance area. And he's going to talk about what they did to really grow that business and the philosophies that he employed over the time. And then also in October, we have a very special event where we're going to have some industry leaders in the semiconductor industry who will talk about what's happening in semiconductors and where the direction is. And I know we have the head of that business for Merck KGaA, which is a leader in supplying materials for the semiconductor industry, who will be speaking. And then, but that's just the events between now and the end of October. So as you can see, we're very active, and we're covering important topics that I think all of us really care about. So with that, what I'd like to do is I would like to turn it over to Kevin. Kevin, I guess, are you going to share your slides?
Yes, I can do that.
Okay, great. And then when he's done going through his slides, we'll have a little bit of a fireside chat, and then we'll open it up to Q&A from the audience. And the way you ask a question is there's a chat function. Just type in your question, and we'll try to get through as many as we can.
Okay. Thank you, Peter. Yeah, I do follow instructions, and it works. Can you see the slides?
Yep, we can see it.
Great, thank you. Yeah, Peter mentioned that I retired last week. For those of you that are thinking about it, it is a great feeling to wake up in bed and not have to go through your day in 15 or 30-minute blocks of what you're going to do, meetings you have to go to, calls, etc. And that's it. It's great. I've enjoyed that for a couple days. So let's get started. We're going to look at energy, the economic and the chemical industry, with really a heavy focus on what's going on in the chemical industry and the various trends that are going on. We will look at both basic chemicals and specialties. That's my focus. The purchasing manager indexes for the United States, they both point to further growth. There's one that comes out on the first of the month, and this is for August for manufacturing, one for services. That's services dominate our economy now, but looking at the details for manufacturing, prices paid are still elevated. Most companies are experiencing rapid increases in the prices they're paying for their raw materials and inputs. Supplier deliveries are lengthened. Inventories bumped up in August. Now, I suspect what will happen with Hurricane Ida, that will go below the 50 break-even level into contraction. Production was above 50 in a fairly good range, and so were new orders. So everything was good. As you can see, looking historically, that it's at a relatively high level. So, it's pointing to further growth. A leading barometer that I had developed over probably 45 years of research into business cycles, which is the foundation for the CAB leading indicator that the American Chemistry Council publishes. I just call it my leading barometer. It's been pointing to slower growth. That said, it's still pointing. It generally takes about 3 months of decline for it to signal a turn in the business cycle. It's not signaling that yet. So, what's happening in the third quarter, we're seeing the effects of, the Delta variant, which is spreading. It's affecting leisure and hospitality to a limited extent, as well as travel. But manufacturing and the goods sectors seem to be doing, fairly well. So I'm going to look at a couple of things. My outlook for housing. A lot of chemistry goes into housing, from the adhesives to, the siding and everything in between. It's chemistry. What's a fairly V-shaped recovery, actually to recent highs compared, not as high, for example, as before the housing bubble in 2005 or thereabouts, but, highs since the great financial crisis have been reached. Been some slowing of activity lately, but it's largely supply side oriented. We had a good report yesterday for the second month in a row. Housing starts and permits expanded. And that's a good sign. They had been somewhat weak in the spring in the second quarter. But the fact that the number of permitted units, houses or units that have been permitted but not yet have been started, I think is indicative of the supply side constraints that home builders are facing, both in terms of inability to get labor, material constraints, things such as that. Many of you have possibly gone to try and buy a new appliance, and there's a long wait list, things like that. Home builders in my area down here in North Carolina, they're finishing houses with a promise to put the refrigerator, washer and dryer, and when they become available. So that's one of the constraints that the industry is facing. But houses that were permitted but not yet started are up nearly 50% year over year compared to a year ago. And that's just indicative of that particular report. Now, we see that improving a little bit, but at roughly 1.5 million units, that's about where demography, the millennial generation coming into the prime home buying age, supports housing activity. So it's going to be a fairly positive outlook for that. The outlook for light vehicle, another sector that consumes a lot of chemistry. V-shaped recovery again started to, there's a sort of an inflection this year, largely because of the semiconductor shortage and the winter storm, for example, made shortages of polyurethanes for seating and other applications, other materials and other applications for the automotive sector. Kind of created that inflection point. The semiconductor issue has not gone away. And so we see that the manufacturers, the OEMs, are cutting back their production schedules. We see that dipping down this quarter and then rebounding up to a level of roughly 17 million units per year. That's actually a very good level. And that supports a lot of chemistry. And the good thing is that vehicles are getting larger. So there's more plastics, more other chemistry in each light vehicle. And as we go towards electrification, it's going to involve all sorts of new chemistries into the automotive sector. So looking at the key customer industries for manufacturing, and what I do is I look at the year-over-year change, and I just sort of assess, is the growth rate accelerating, or is it decelerating, or is it in decline? Nothing's declining year over year. So we can forget about the right-hand side of this chart. Virtually, all of these segments that we monitor are expanding. Most of them are accelerating if you compare their activity to, say, the latest 3-month moving average to the prior 3-month moving average. They're expanding, they're accelerating. There's a couple that are decelerating. Motor vehicles and parts is one. I just talked about that, and some of the others. Largely because of supply side constraints. You just can't get the parts for appliances or the semiconductors for automobiles, so on and so forth. So everything's good looking forward. This is a heat map of the same market segments that we look at. And there's some discussion there of industrial production. That's a key metric that I like to look at in terms of growth, but fairly solid growth, well over 5% this year. It's going to fall back in 2022 and 2023, but we would expect that is the expansion, and we are now in an expansion. The second quarter GDP data showed that the prior peak had been breached, so we've gone from recovery to expansion. But pretty much, you can see in 2020, most of the segments were in the red. Some very deep red, some not so red. A couple industries that were green were, computers, and then their inputs, semiconductors and electronics were in the green last year. We see pretty much everything in the green this year, with the possible exception of printing. That's a technological play that we just don't look at things in print anymore. We read books on our Kindle or our iPad, or we read the Wall Street Journal. I certainly, the only time I look at a Wall Street Journal in a hard copy is if I'm staying at a hotel and they put one outside my room in the morning. So everything's in the green, and going forward, it looks a fairly good environment. Some slowing activity, but again, these are typically sectors that apparel, textile products, they're in structural decline. So let's look at energy prices. I can now finally talk about oil prices, and I would say that in the near term, they will probably trade in the range of $60 to $80 per barrel. I don't make forecasts very far out for oil or natural gas prices, but one way that we assess the competitiveness of the petrochemical industry is to look at Brent divided by the Henry Hub. You get a rough ratio. Whenever that ratio is above 7, we're competitive. You can see in the 1990s and early 2000s, the noughts, that we weren't. But with the shale gas revolution, we have been very competitive. That spike in the ratio in 2011 led to a surge of new project announcements, probably peaked in 2014 or thereabouts. Those projects announced them. It takes 6 to 8 years are now coming online. I'll talk about that further. But looking out, the forward rates for Brent and for the Henry Hub looks to be quite competitive. Even though natural gas prices have gone up this year to around even over $5, I think they settled a little bit below 5 yesterday, which elevates it and brings the ratio down. But for the year as a whole, it's going to be fairly good. And going forward, it's a good environment. As I mentioned, this is a good leading indicator of when capacity comes on stream. We've been tracking this since 2010. This is the number of projects that were announced net that year. The ones that were announced, less the ones that were possibly canceled. If it was, and so, as I said, it peaked in 2014. Takes 6 to 8 years to build a chemical plant, or 8 years for a large petrochemical complex, a cracker. And so those projects have been coming on stream the last couple years, this year and next, and then it begins to taper off. What that implies is that possibly towards the latter part of this decade, operating rates should go up quite a bit if demand continues to increase, as we suspect it will. And that will foster renewed reinvestment economics for petrochemicals and synthetic materials and the such. So looking at the number of projects, as you can see, it's a leading indicator of the change in capacity. The one peaked in 2014, and now you see it peaking. There's a large gain in 2018, and then some large gains in 2020, 21, 22, and that tapers off for some time. So now let's look at, this is through the second quarter. Producer inventories of basic chemicals and synthetic materials are very low. Okay, there's about 46 months or thereabouts, 45 months of inventory, or 15 months over the month, any given month. I suspect at the end of the third quarter, this will be drawn down quite a bit. Factor behind that was the winter storm, Uri, affected production of basic chemicals and synthetic materials. Severe supply chain shortages, loss of capacity for a lot of resins for a long time. Inventories were drawn down. Listening to some of the CEOs talk, they were looking towards the end of the year that it would take to rebuild a lot of those inventories. And now with Hurricane Ida, we've been set back. We just can't seem to win this year with the weather. So I suspect at the end of the third quarter that it'll be drawn down again. And it probably won't be until 2022 that inventory gets built up again to levels that everybody is comfortable with. This is just a headline. I like to look at production in terms of tons rather than the production indices of the from the Federal Reserve Board. There's some issues with those, and I'm working right now on a project to come up with really reasonable monthly measures of chemical industry activity based on production. Writing up a kind of a white paper on that right now. This just shows inorganics and building on top of that organic chemicals, which includes the bulk petrochemicals and the organic intermediates, resins, rubber, and the fibers, just layering those on top of each other. Again, a drawdown from Hurricane Uri. We'll see something this quarter as well, some softness, and then going forward, that continue to expand as that capacity improves. There's a measure of capacity, that blue line at the top, and then looking at production below, which is essentially the top line number of the chart before. Kind of a widening gap, as you would expect, but starting to close as we get out, 3 or 4 years. So what does that do to capacity utilization? It went down in the COVID recession. It was soft earlier this year, but we see that gradually starting to improve as we go forward. And when we get to the second half of the decade, actually, I think it'll be quite high, up near 90% or so, just because there's a dearth of new capacity coming on stream in the second half of the decade that will present reinvestment economics. So I'm just going to quickly go through some of these. I didn't look at inorganic chemicals, a little bit different, but I'm going to look at a couple of the basic chemical segments. This is just bulk petrochemicals and other organics. It's the olefins, the aromatics, plus methanol, and then everything that's derived from those. And you can see a gradual uptrend since, the last 10 years or so as we brought capacity on. This is quarterly production. You can see the effects of the COVID-induced recession. You can see the effects of some of the weather events, but we see that continuing to expand as we go forward, and there's the numbers. And hopefully, Peter, you will make these available to your members as a PDF. Plastic resins, where pretty much 78% of the bulk petrochemicals go into. It's a tangible form. It's the stuff that's largely exported. Same sort of pattern, a little bit stronger growth slope. We see, again, the effects of the COVID recession, which was temporary. I remember back in April of last year, we saw PVC production fall by half in 1 month, but it quickly rebounded. And actually, plastic resins was one of the few industries, along with semiconductors and other electronic components with computers, as industries, major industries that grew last year in terms of volume. We see, there's some weather events in there, but we see that continuing to improve. A really good prospect here. A lot of that will depend on our license to operate as we go forward in terms of an export environment and also domestically as well. There's some policy issues. There's the inorganics. Okay. Mature segment. I kind of switched these slides around. Again, fall off last year from in production. We see that improving, but it's a very mature segment. And, it's largely with chloralkalis, other inorganic chemicals, pigments, and the such. And then looking at synthetic rubber, another major basic chemical segment or synthetic materials segment, a fall off because of the COVID recession. I mean, tire production just fell apart last year. At one point, it was off by 95% from the peak to the trough. It's recovered a little bit. We see that continuing to improve, but there'll be more imported, tires coming into this nation. And then manufactured fibers, it's a sector that's in long-term decline, a little bit of a cyclical recovery last year, but it's now entering a phase where it's going to be re-entering at long-term structural decline once again. It's just that the customer industries are moving offshore. The apparel segment's essentially gone in this country. What's left is industrial applications, things such as that, tires, automotive, and things such as that, but again, in long-term decline. So let's turn to specialty chemical and we monitor 28 of these segments. I just layered these on top of each other. I just picked some of these at random. I'm not going to go through all 28. You just don't have the time. But I just picked some of these largely because they're major segments, or I just think they're interesting or indicative of some of the different dynamics of each. So, adhesives and sealants, steep decline during the COVID-induced recession, steep uptick And we have now reached new levels of activity, a lot of do-it-yourself projects last year. The construction segment was quite good for home builders on that segment. So we see that continuing to improve and then leveling off as the housing activity tends to reach a plateau around over 1.5 million units per year. There was a big push towards remodeling as people were stuck at home. This last year, the last 18 months, and they looked around and said, gee, I'm not taking vacations. I might as well do something with the house. They did additions, they remodeled the kitchen, so on and so forth. A lot of adhesives, embedded in that. Well, a lot of those projects are over with now. You're not going to do a second or third kitchen remodeling or bathroom remodeling. Anybody that's gone through one will know what I'm talking about. You don't want to do it again. So you're just not going to have the return of that activity. So catalysts, this is largely environmental catalysts that for in electricity generation to a lesser extent, but mostly automotive. And so it reflects that. It also reflects petroleum refining. There's some processing catalysts, chemical manufacturing, olefins, so on and so forth, polyolefins tied in with that. We see a recovery of that. But as we go towards electrification of the automotive fleet, I mean, there's a goal right now of 50%, I think, by 2035 of the cars or light vehicles sold in this country being electric. That's going to eat into this. They don't need a catalytic converter. Volume-wise, it's not a major segment compared to some of the other segments, but it's a very profitable segment in terms of its value. Coatings, this includes it's dominated by architectural coatings, but there's also OEM and specialty coatings, things like marine coatings and things like that. Sharp downturn. Again, that do-it-yourself remodeling phenomena of last year at play. We see that continuing to improve, reaching new highs, but then tapering, the growth tapering off, sort of an inflection point. Still growing, but because it'll be more of the OEM and specialty coatings taking over in terms of volume growth and the such. So cosmetic chemicals, an area that actually did quite good last year. Not so much for cosmetics in themselves, but we bought all those hand sanitizers. Wherever you want, there are hand sanitizers. There's chemistry in there. There was a short downturn. We see that continuing to proceed, gaining strength in the next couple of years, but at possibly a slower pace of growth than what we saw, certainly in the last 5 or 6 years. Food additives, another segment that did well. People were at home. They ate a lot. There's things of people kind of like the freshman 15 or something like that, people putting on weight. Now that they can go to gyms, they can start taking that off. But a lot of, our food is largely processed, and there's a lot of additives that go into that. And we see that largely follow, a positive outlook going forward, but slower growth, but growth nonetheless. Largely following the caloric consumption of the American public. Oil field chemicals. This one's kind of a very volatile segment. It includes production, chemistry, fracking for oil and gas has led to very strong growth since the great financial crisis, when this really took off. With prices of natural gas and oil, the cost of extracting them going down, these learning curve effects really coming into play. And you can see it kind of varies with the price of oil. There's a collapse in the price of oil, 2014 to 2016, 2017. And then the oil prices went back up. The rig activity went back up. It collapsed last year. But this is an area that's actually, I'm pleasantly surprised, is doing quite well in terms of its volume improving. We see that it's largely going to depend on the rig count. And going forward, we see that, again, reaching another inflection point, but continuing to grow, but just slower. Plastic additives. Largely concentrated in PVC, sales and captive use or consumption demand. A lot of that activity had been reshored to other parts of the world. And what we see at play right now is, there was a downturn last year, but we see fairly good growth going forward, largely because of the reshoring of the supply chains to North America. There'll be these regional centers. We're still plagued in this country all across the economy. I am a participant, or have been a participant, with a group of trade association economists from agriculture to mining to utilities, construction, all of manufacturing, finance, utilities. And we go do a roundtable when we meet every quarter, and they ask, like, what's going on in your industry? And to a person, the last meeting I attended, which was in May, they were saying, we can't hire talent, labor, issues, supply chain issues was probably, the phrase that everybody mentioned. But so it's still at play. We see a lot of reshoring activity coming here. A lot, and so a former colleague of mine at ACC, Heather Rose Glovacki, she tracks this, and she's tracked over 1,000 different projects of plastic products producers, new projects, in the last 5 or 6 years or so. Rubber processing. Sharp downturn. It's recovered somewhat, but very little growth, paralleling the activity in rubber products production. Tires, other products, belts, hoses, things such as that. Probably a little bit more reshoring in those segments. Textile specialties. I chose this one. It's sort of an industry that's in long-term decline. I mentioned that before, but this just illustrates that there was a cyclical rebound. We're reaching this an inflection point. Some of the latest data show that it's starting to show some negative months. Maybe 2 months for every month that it's positive, and so I think we're reaching an inflection point. And so long-term demand for textile specialties will continue to decline as we go forward. And then lastly, the last segment I look at, water management chemicals, going into water supply and wastewater treatment. But also there's a lot of industries that use an awful lot of water beyond electricity generation. The chemical industry is a major one, petroleum refining, the paper industry. So as those industries recover, we see further growth in this particular segment. These are sort of the long-term prospects for these specialty chemical segments. Fairly good growth. It's not like it was in, say, the 1980s or 1990s, but some very strong segments. Electronic chemicals, demand in this particular region will be strong, largely because of the reshoring of semiconductor manufacturing here and printed circuit boards, things such as that. Strong gains in plastic additives. I mentioned that too. Plastics compounding, plasticizers to a lesser extent. A couple of segments that are in structural decline. Again, dyes, textile specialties, and printing inks. You would expect that these would not be growth segments as we go forward. So, summary, some of my concluding thoughts. We're well into recovery from the pandemic-induced recession. It's just that this year the weather is not, cooperating. And I remember there was a hurricane, I forget the name of it, that, my last week was sort of a blur. Working at ACC, so I forget the name of the hurricane. It was a kind of a minor hurricane that went up through Texas. Some plants did shut down temporarily or got ready, but I thought, here we go again. But it turned out to be minor. Um, so Hurricane Ida resulted in further inventory depletion, rising demand, higher selling prices. We've seen that pretty much across the board. So the supply-demand imbalances are going to be kind of out of whack for some time. They'll return to normal next year, I suspect. Longer term, in basic chemicals and specialties, we'll continue to have an advantage from shale gas. It's a competitive advantage. Again, a lot depends on our license to operate. These are inside the Beltway policy decisions. There's a lot of wacky ideas being thrown out there. For those of you that are members of the American Chemistry Council, my colleague Martha Moore is now the Director of Economics and Statistics, and you are in good hands. So as a global economy and domestic end-use markets improve, we're going to see continued gains across pretty much all of the segments. They're going to be in the green. Within basic chemicals, it's going to be plastic resins and bulk petrochemicals and other organic chemicals. And then a large number of really dynamic specialty chemical markets, electronic chemicals, plastic additives, plastic compounding, etc. Investment will be easing, for those of you that, supply pumps, valves, things such as that. You're going to have a couple of, some prolonged years where it's going to be relatively leaner than it has been, say, the last 5 years or 10 years. But towards the end of the decade, it should pick up as markets get tighter. And of course, there's a lot of risks that are abound. The one short-term one is if the spread of the Delta variant was to spread further, that may put a dent in economic exchange. There's the geopolitical things, with China and elsewhere. So many. So, okay, that's my contact information. To follow me on Twitter. I still maintain my tweeting of economic indicators and chemical industry indicators and things such as that. And now that I'm no longer a employee of the American Chemistry Council and have to kind of watch what I say, I could probably comment on some of the silliness coming out of Washington. There's my contact information, and please let's have a dialogue. If I love talking with people.
Okay, great. So, Kevin, if you could unshare your slides so that we, get the full size of the. There we go. Okay.
There we go.
Yeah. Well, I have to tell you, Kevin, what a wonderful presentation. And actually, the takeaway I see is, although there's some big picture trends, so much of it is a case-by-case situation, right? So
yes.
Textile specialties versus electronics, and the growth prospects and the competitive thing can be very dramatically different. So, one of the messages here is, although the big picture issues are important, at the end of the day, each of the people in our audience who are participating, whether it's in coatings or electronics or whatever, will face a different set of dynamics, and either will have a wind in their face or the wind behind them, depending upon what the story is. The good news is at least the dynamics in each case are understandable, right? It's not a mystery why textile specialties are going down, because they don't make shoes and jeans in the United States, and there's a point at which that an Asian producer of textiles is not going to buy stuff from Europe or the U.S. Textile specialties, they're going to gradually buy things from their own country, right? So, well, I have a couple of questions. And first of all, though, I want to encourage everyone in the audience to please type in questions that you want to ask and use the chat function, and we'll watch as they come in and allocate enough time to go through them at the end. So, first of all, I have sort of the following question, which is, obviously the pandemic had a big impact on the economy, and it also had an impact on logistics and supply and so forth. How many of those things, and obviously it had some effect on the chemical industry, although thank God it wasn't as bad as, say, people in the entertainment industry, where demand went to zero, right?
Right.
So tell me, of the things that the pandemic had an effect on in the chemical industry, what are the ones that you think were short term that may go away or may have already gone away? And what are some of the ones that you think are going to be longer term in terms of their impact?
Well, the industry, a lot of the products that we produce, I think, for example, polypropylene, it's used in nonwovens, medical gowns and the such, the PPE equipment. So there was a rush for that sort of thing, a rush for isopropanol, other things that are used in hand sanitizers. There were shortages for a while. That sort of abated. I've noticed as I go into, say, a gas station or something like that, they started selling the hand sanitizers, and the price seems to be going down. So to me, it's sort of indicative that they have like excess inventories of little bottles of hand sanitizers. I mean, they were ubiquitous, no matter where you went. You went to the barber, they sold them. You went to a gas station, a convenience store, pretty much everywhere else. That's something that was probably transitory. Thinking of some other things, some of the supply chain constraints, for example, active pharmaceutical ingredients going into pharmaceuticals, drugs, things such as that. There's still issues with that because a lot of that activity had been, and that's a segment I really didn't cover, but a lot of that have been in the last 10, 15 years, we've set up supply chains that extend to China, to India for low, value-added type active pharmaceutical ingredients or the pharmaceuticals themselves. I invite any of you, when you go to buy something, when you're at Walgreens or Walmart or wherever you shop, and you buy a tube of toothpaste, you might be surprised that a lot of these things are manufactured in China, for example. So a lot of those supply chains, they're still disrupted. There's an article in today's Wall Street Journal about how literally, I think in the last week or so, or last month, I can't remember the time, that the number of container ships off of LA Long Beach has doubled. And so there's all these supply chain issues. And I know economists, in the profession, they just sort of go to the blackboard and say, well, assume this and assume that. And they really need to take into account, and politicians are probably even more guilty of this, that it takes time to adjust these things. It took us 20 years to build up these supply chains to Asia. It's going to take more than 2 weeks or 2 months to rebuild some of these supply chains with maybe a North American focus.
Yeah, in fact, one perspective, and this is the view I've heard from many of the CEOs that we work with, what they said, some of the negative things that have happened, and I'm glad that you actually indicated there's some things that benefit during the pandemic, like hand sanitizers and synthetic fibers, for gowns and things like nonwovens. So there were some industries that did well, but many suffered. But actually, a lot of the CEOs that I've talked to said, many of these things were things that were a problem already, right? Like supply chain was becoming a problem anyway, but the pandemic just made it worse. And so they kind of say, well, like the shortage of truck drivers. Well, that didn't start just in March of last year, right? It's been going on for a while. It's just accelerated a lot of the these trends. By the way, one CEO who's a friend of mine, he said, one thing I can comment on with regard to hand sanitizers, he said last year was the first year that more alcohol went onto my hands than I drank. So he says, I hope that's not a permanent trend.
Yeah.
So you're saying some things will continue to be an issue, but a lot of things will go away. I guess that's what you're saying.
Well, some things will likely go away. They will be resolved, but it's going to take time. As I said, it's not going to take 2 months. It may take 2 years in some cases. I talk with people in the electronic chemicals business, the semiconductor industry, and these are issues that are going to still be around in 2022 and possibly 2023.
Yeah.
So,
yeah, quite honestly, I do think, and I'd like your opinion, I do think that the geopolitical changes and tariffs had at least as much of an impact on the chemical industry. The tariffs that suddenly changed which products were economic to make in China versus the US, or where you could get things, and the tensions between different countries, et cetera. I mean, I think that has had a big impact independent of the coronavirus.
Right. Well, if you go back to, say, 2011, the Fukushima earthquake, and there were, some plants that were affected that were the sole supplier of certain electronic chemicals. And, the semiconductor industry was in distress for a while. If you look at the data, that one chart I had on producer inventories, you started to see around that particular period of time a buildup of inventories, excess in terms of monthly sales, and it could be related to that. I think for a lot of CEOs, that was a wake-up call that we need to build some resiliency into the system. It's just not reducing costs. Not being able to produce or supply is a cost as well. And then certainly the trade war from 2017 into literally the end of 2019 accelerated that. There's many companies, not only in our industry but in others, found that their input costs had gone up. Whether it was steel or other products. So,
yeah. Another question, Kevin, which I'm sure you've given a lot of thought to, is the issue of inflation. I think a lot of people have been concerned about the increase in inflation and what impact it has not only in the chemical industry but industry in general. What's your view on how should we interpret the increases in inflation that we've seen thus far this year, and to what extent do you think that's going to continue, or do you think it's a temporary one? You have people on either side of that argument today.
Yeah, they do. Yeah, and I really don't like the word transitory, although I used it before, because I'm transitory. 30 years from now, I'm not going to be here. So let's look at consumer price inflation divided into two things. Okay, we had rising year-over-year comparisons. The point that I would make, you have to look at the month-by-month changes, and they're still quite strong. But a lot of the things that are, quote, transitory or temporary, they have begun to ease. But those are things that are related to, for example, leisure and hospitality, airfares, hotel rooms, things such as that. That are now starting to ease. They were tight for a while, but as those industries, they came back, prices went up, there were supply constraints and the such, starting to ease because of the Delta. But there's a lot of other things, food, energy prices are certainly going up. The price of oil, let's not look at the WTI, let's look at Brent in May of last year was $15 a barrel. It's now, 70 plus or thereabouts. That's going to, filter through a lot of the things that we purchase. The cost of moving things. And there's a lot of these supply chain constraints that have resulted in, outside of those, temporary sectors, where those issues just aren't going away. It's still hard. It's still hard to. I know Bob Costello with American Trucking Associations, and that's all he talks about. They can't get drivers. Some of it's because of government regulations, but they also have problems of getting equipment. Getting equipment maintained is an issue too, because there just aren't the mechanics available anymore.
Mm-hmm.
So a lot of these issues are going to take time to filter through. I mean, if you look at in terms of industrial arts or something like that, we've promoted 4-degree colleges for pretty much everybody, the guidance counselors, the last 20 years or so. We haven't been pushing people into, the trades, technical training into such. So we're facing that shortage right now. Welders, truckers, you name it.
Are the chemical companies having difficulty passing on these raw material costs, in terms of pricing, or does it depend upon who they are and what they produce?
I think it depends on who they are and what they produce. We internally monitored prices. We never really published anything, but I became, in the last year or so, I became addicted to the ICIS news feed, news stream. So I would look at, I would have to say, looking at the recent weeks where I looked at it, it was probably 9-to-1 price increases of things.
Yeah.
It was actually for the year before that, it was probably 10 out of 10 were price increases. There's very little that was going down in price. So yes, it does look like they were passing a lot of those costs on.
Another question, a lot of what we're talking about are structural changes. And, if you look at the history of the chemical industry, there are times where there are structural changes in the industry, and then there are times where there were structural changes in the economy or in so forth. So an example of a structural change in the industry was the shale gas, right? That suddenly changed the cost position of U.S. producers, North American producers, and that had a dramatic effect. But then there are other things, big structural changes in economies and so forth, as production of certain things moved to China versus the U.S. and Europe and so forth, and that had a big impact on the chemicals. So, what are some of the structural changes that are either in the industry or in the industries that they serve that are going to have an impact? Certainly, one or two that people cite is, for example, electronic vehicles obviously is one good example of a structural change that will affect anyone who supplies the automotive industry, right? But what do you see as the big structural changes, and which of those are going to impact on the chemical industry?
Well, electrification of the vehicle fleet will be one. More demand for polypropylene, certainly, because that's what the battery packs are encased in. Chemistries beyond that, lithium, type chemistries, other chemistries will have an impact there. There's that. Another thing I think is sort of a trend would be the restructuring of or reshoring of a lot of our customer industries, digitalization of our industry. If I was at, say, the Broadmoor, the annual meeting of the ACC 10 years ago, and I asked somebody about, what's your digital strategy, they probably would have looked at me definitely 15 years ago as if I had two heads on my shoulder.
Mm-hmm.
Right now they're hiring, companies are hiring all sorts of data scientists or quantitative oriented people to look at the data they're collecting in sensors on their customers, and they're tweaking and doing things. That's a major change. Electrification, digitalization of the economy in general presents opportunities. I see there's some questions here.
Yeah, we do. The first question I have here is from Jim Weatherall, who's
Hi, Jim.
Chem, but also
Fred
an
Senior.
officer and a board member of Societe. He says, question for Kevin. Thank God it's for you, not me, right?
Yeah.
With regard to plastics, what will be the main growth drivers, automotive, beyond automotive, and threats to that growth, such as environmental issues?
Well, some of the growth will be, clearly the move towards recycling or bans on single-use plastics will affect the packaging markets and those particular resins. But there's very strong growth in durable, plastics for durable goods. And as those industries are reshored, there will be opportunities. A lot of interest in chemical recycling, advanced recycling by the chemical industry. That is, taking recycled plastics, some chemical processing goes on, the raw materials are produced or extracted from that. A lot of investment going into that, not only by the plastic resin companies, many of which probably didn't want to hear about it 5 or 10 years ago. And so a lot of interest in that. A lot of them are partnering with other companies, a lot of startups and such. So a lot of opportunities. Also, the whole renewables and sustainability issue will present some challenges, but also some opportunities. I see a question from Fred Seamer about green hydrogen. I think we have some very good air separation companies in this nation that will rise to the challenge of that. So all sorts of opportunities for that. There's a lot of interest on the part of the industry for decarbonization. Can we do it or can we not? Where are the opportunities in terms of technologies and the such? So these are all things that are just sort of being sorted out.
Yeah, that's right. So yeah, there is this question, right, from Fred about green hydrogen, et cetera. One thing's for sure is there are a lot of companies who are working on either chemicals from renewable raw materials or a smaller set of people who are looking at circular chemistry, where they can take something made out of plastic, whatever, and then convert back into virgin plastic. Any comments on that, or is the impact on that going to be, no one's in an advanced stage, right? But do you see that being a significant factor?
Well, the chemical recycling, they're going from pilot plant to commercial demonstration plants. So we'll start to see, I think, some really commercial scale plants being developed. It's a sea change of thought. I'm thinking of one CEO that I know, I won't mention the company or the person, that probably 10 years ago would have been adamantly opposed to recycling at all, is now actually one of his biggest proponents. And you're seeing a lot of that across the board, among chemical companies, a recognition that ESG is important, and we have a lot of the enabling chemistries that are going to make a lot of these ESG, the E and S challenges possible. So we are one of the great enabling industries. And so, there's a lot of opportunities out there for the right chemistries.
So, Kevin, I'm going to end with a difficult question, which is not necessarily your area of specialty. So, seems like so many of these tragedies of problems are the name of the company or the name of the ship starts with ever. So, like the Evergreen, the ship that blocked the Suez Canal, whatever. So now we have Evergrande, right? Evergrande, which is that huge development company in China with, depending upon how you count, debts of anywhere from 180 billion to 300 billion. And so last 5 days, that's what no one can talk about anything other than Evergrande and whether it's going to implode and then have a cascading effect on housing and everything in the Chinese economy. I know that's kind of an unfair question because it's not a chemical industry question, but as an economist, what are you hearing and what do you think is happening?
Well, it's a good example of a zombie company and low or zero interest rate policies or low interest rate policies in China in the bubble of debt. It just isn't sustainable from what I've read. So, in the past, the CCP has come to the bailing out of companies such as this. I don't know. It is having ripple effects. We see it in our stock market. We see it in the share prices of similar companies in China. There's a retrenchment in terms of a free market orientation back towards more centrally planned, a greater role of the CCP. What's going to happen? The company very well may be allowed to default and go out of business. I suspect the bondholders, the shareholders will lose. And I think possibly, there's many people, that have put money down, 100% down for an apartment or a house. I think they would be bailed out because if you don't do that, you have a lot of really
angry Chinese
people.
Angry Chinese, right?
And it's not just, they have relatives. So, brothers and sisters, cousins or whatever. So it'll be a lot of people. So I suspect they will be bailed out. There maybe are other more solvent developers that could pick up some of those pieces and complete those with some sort of guarantee or subsidy by the central government.
But it's really a real dilemma for the Chinese government because no matter what they do, there's a plus and a minus. For example, if they let it go bankrupt, then obviously there'll be just a cascading effect and on individuals, but also all this construction and the debt markets and maybe other property. And that'll have a huge impact on growth. And the Chinese government, part of their power is by telling people, well, we've achieved growth, so you may not have much freedom, but you have, we're creating growth and jobs. And on the other hand, if they bail it out, then they won't deflate this horribly inflated housing market. And they've been trying to stop it for a couple of years now, and they've failed. So I'm not sure I would say that I always feel sorry for the Chinese government, but in this case, they've got a big problem, right? And the other question is it going to be a Lehman Brothers kind of event or something else? But no matter which way they go, it's going to have a negative effect on something, right?
Yes. Yeah, it's a dilemma. Yeah.
So with that, we always promise that we start on time and that we end on time. Kevin, you lived up to your billing. A wonderful presentation, and it's great to discuss these issues. What I want to tell all of you is that we now have the other exciting event, which is the networking session afterwards. What's going to happen is you don't have to do anything. All you have to do is I'm going to switch everyone into the electronic ballroom. There are going to be a whole bunch of tables that seat up to 8. And what you should do is click on a seat, and you'll suddenly be in a Zoom-like session where you can see everyone at the table. Kevin is at table number 1, and I've labeled it Kevin Swift so that you can tell exactly. So the first 7 people will be able to talk to him, but we're going to do it for about a half an hour. But this is a new feature because it's a way for all of you not only to hear a great speaker, but also have a chance to meet with each other. And we've got quite an impressive group of attendees today. So with that, I want to thank Kevin again for a wonderful talk. And in about 10 or 15 seconds, you will all end up in the electronic ballroom, and we look forward to seeing you there.
All right. Thank you, Peter.